time. Ever wondered what the stock market really is? Let's break it down simply and quickly so you can understand its core purpose and how it operates. The stock market is essentially a marketplace where shares of publicly traded companies are bought and sold. When you buy a share, you're purchasing a small piece of that company, making you a part owner. The value of your investment rises and falls with the company's performance and market conditions. But why does the stock market exist? It serves two main purposes. First, it allows companies to raise money by selling shares to the public. This capital is then used for growth, expansion, or new projects. Second, it offers investors a chance to own a part of these companies and potentially earn profits as they grow. The prices of shares in the stock market are constantly changing, driven by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more want to sell, the price drops. This dynamic creates opportunities for investors to buy low and sell high, or to hold onto shares long term as the company grows. The stock market is also influenced by a variety of factors, including economic data, corporate earnings, and global events. These can cause prices to fluctuate, sometimes dramatically, which is why understanding how the market works is so important for making informed decisions. Whether you're looking to invest for the long term or trade more actively, knowing the basics of the stock market gives you the foundation you need to start navigating this exciting and dynamic world. With a clear understanding of its purpose and how it operates, you're better equipped to make decisions that align with your financial goals and take advantage of the opportunities the market offers. The stock market is where shares of publicly listed companies are bought and sold, serving as the meeting point for investors and traders to exchange ownership in these companies. It's a dynamic environment where buying and selling shares can lead to opportunities for profit or growth. Some of the most well-known stock exchanges where this trading takes place include the New York Stock Exchange, or NYSE, and NASDaq. These exchanges are where the action happens, with millions of shares changing hands every day, representing ownership in companies from all over the world. Understanding how these exchanges work is key to navigating the stock market effectively. Whether you're buying a share in a tech giant or a smaller company, it all happens within the framework of these exchanges, where prices are constantly moving based on supply, demand, and market sentiment. But why does the stock market exist? Its main purpose is twofold. First, it provides companies with a way to raise capital to grow and expand. By selling shares to the public, companies can generate the funds they need for new projects, research, development, and overall business growth. Second, the stock market offers individuals the opportunity to invest in these companies. As an investor, you can buy shares and potentially earn profits as the companies succeed and their value increases. It's a system that supports business growth while giving people a chance to share in that success through their investments. When you step into the world of the stock market, understanding the basics is your first step towards mastering it. Let's start by exploring shares and stocks. Now, when you buy a share, you're not just buying a piece of paper or a number on a screen. You're actually acquiring a small slice of ownership in a company. This means you have a stake in its success, and your fortunes rise or fall with the company's performance. But how is the price of these shares decided? It's not as simple as it might seem. The value of a share is influenced by a web of factors, each playing its own role in the market dance. A company's performance, for instance, is a major player. If a company is doing well, With increasing profits and growing market share, its stock price usually climbs. Investors see the company as a good bet, driving demand for its shares higher, which in turn pushes up the price. However, it's not just about the company itself. Market conditions also play a critical role. Broader economic trends, interest rates, and even political events can send shockwaves through the market, affecting share prices across the board. Sometimes, even if a company is performing well, external factors can drag its stock price down. Then there's investor sentiment, the mood of the market. This can be a bit tricky because it's about perception as much as reality. If investors believe that a company will do well in the future, they're more likely to buy its shares, driving the price up. On the other hand, if there's fear or uncertainty, even the best performing companies can see their stock prices dip. But these are just the basics. As you dig deeper into the stock market, you'll find that the factors influencing share prices are even more complex, involving everything from technical indicators like Bollinger Bands and stochastic oscillators to broader economic indicators like unemployment rates and consumer confidence indices. Understanding these elements gives you the tools to navigate the market with greater confidence and insight. So, as you venture into the stock market, remember that buying a share is more than just a transaction. It's a commitment, a bet on a company's future. And like all good bets, the more you know, the better your chances of success. Now, let's turn our attention to the concepts of bull and bear markets, two terms you'll hear often in the world of investing. These aren't just colorful labels, they represent the overall mood and direction of the market, setting the stage for how investors make decisions. When we talk about a bull market, we're referring to a period when prices are rising or are expected to rise. This environment is marked by optimism, where investors feel confident about the future, and their enthusiasm fuels further growth. It's a time when the economy is generally strong, companies are reporting healthy profits, and the overall sentiment is positive. Think of it as a self-reinforcing cycle. As prices go up, more investors jump in, pushing prices even higher. On the flip side, a bear market tells a different story. This is when prices are falling or are expected to fall, and it's often accompanied by a sense of pessimism or uncertainty. In a bear market, investors are more cautious, selling off assets to avoid further losses, which in turn drives prices down even more. The atmosphere can feel almost contagious as fear and doubt spread across the market. To really grasp these concepts, let's look at some historical examples. The bull market of the 1990s is a classic case, driven by the rise of technology and a booming economy. It was a time of soaring stock prices and widespread investor confidence. On the other hand, the bear market during the 2008 financial crisis painted a starkly different picture. Triggered by the collapse of the housing market and a wave of financial failures, it was a period of sharp declines, deep losses, and widespread fear. These cycles of bull and bear markets are natural parts of the financial world, reflecting the ever-changing landscape of economic conditions and investor psychology. Understanding them helps you anticipate market shifts and make informed decisions, whether the market is roaring like a bull or retreating like a bear. Grasping the mechanics of placing orders in the stock market is fundamental to trading effectively. Let's start with the most straightforward option, the market order. When you place a market order, you're telling your broker to buy or sell shares immediately at the current market price. It's the fastest way to execute a trade, getting you in or out of a position almost instantly. However, the catch is that you don't have control over the exact price you'll get. The market moves quickly, and by the time your order is filled, the price could have shifted slightly. This is where the limit order comes into play, offering you more precision in your trading. With a limit order, you set the exact price at which you're willing to buy or sell a stock. Let's say you're looking to buy shares, but only at a specific price point. You can place a limit order to buy those shares once the market price hits your target. This gives you greater control and ensures you don't end up paying more than you're comfortable with. On the other hand, if you're selling, a limit order allows you to set the minimum price you're willing to accept. This means you can avoid selling at a lower price than intended, especially in a volatile market. The trade-off with limit orders is that they don't execute immediately. If the market doesn't reach your specified price, your order might sit there unfilled for a while. Both market and limit orders have their place in a trader's toolkit, each offering its own advantages depending on your priority speed versus price control. Knowing when to use each type is key to executing your strategy effectively in the ever-fluctuating world of stocks. Next up are stop orders, a critical component of any effective risk management strategy in trading. Let's begin with the stop loss order. This tool is designed to automatically sell your shares when they hit a specific price, effectively capping your potential losses. Imagine you've bought a stock and want to protect yourself from a sudden downturn. By setting a stop loss order, you ensure that if the stock price drops to your predefined level, your shares will be sold automatically. It's like having a safety net, preventing small losses from turning into big ones. But what if you want even more control over how your trade is executed? That's where the stop limit order comes into play. This order is a bit more sophisticated, blending the protective features of a stop loss order with the precision of a limit order. Here's how it works. You set a trigger price, just like with a stop loss order, but you also set a price range within which you're willing to sell. Once the trigger price is hit, the order turns into a limit order, meaning your shares will only be sold within the price range you've specified. This gives you more flexibility and control. For instance, if the market is particularly volatile, a stop limit order ensures that your shares won't be sold for less than a certain amount, even if the price is rapidly declining. It's a tool that offers an additional layer of protection, allowing you to manage your trades with more precision. Incorporating stop orders into your trading strategy is not just a good idea. It's essential for managing risk. Whether you're using a straightforward stop loss to shield yourself from unexpected losses or a stop limit order for more tailored control, these tools help you navigate the market with confidence, knowing you've taken steps to protect your investments. Let's bring these concepts into practice using RTrader Pro, a platform that makes managing your trades and protecting your investments straightforward. If you're looking to set up a stop-loss market order, the process is simple. You start by selecting the stock you want to protect. Then you choose the stop-loss order option and enter your trigger price, point at which you want your shares to be sold if the market turns against you. This feature is a powerful way to safeguard your investments, automatically stepping in to limit your losses without you having to constantly monitor the market. Similarly, setting up market limit stop and stop limit orders in RTrader Pro is just as intuitive. Once you've chosen your stock, you can fine-tune your settings to align with your trading strategy. For a market limit stop order, you'll set a trigger price just like with a stop-loss order, but you'll also define the specific price range within which you're willing to sell. This gives you more control over the execution of your trades, ensuring they align with your risk tolerance and investment goals. Stop limit orders work in much the same way, allowing you to combine the protective trigger of a stop order with the precision of a limit order. As you adjust these settings in RTrader Pro, you're tailoring each trade to fit your overall strategy, whether you're aiming to minimize risk, secure profits, or maintain control over how your orders are executed in the market. By mastering these tools within RTrader Pro, you're not just executing trades, you're managing your portfolio with a level of sophistication that aligns with your financial objectives. It's all about making the platform work for you, ensuring that your trading strategy is as robust and responsive as possible. As we come to a close, let's reinforce the key takeaways. The stock market is your arena for buying and selling shares, and mastering the different types of orders market, limit, stop loss, and stop limit can significantly elevate your trading strategy. Each order type serves a specific purpose, giving you the flexibility and control needed to navigate the market with confidence. RTrader Pro equips you with the tools to manage these orders efficiently, helping you implement your strategy with precision. By understanding how to use these features, you can better protect your investments and capitalize on opportunities, ensuring your trades align with your financial goals. Keep these principles in mind as you continue to explore the dynamic world of stock trading. Before we sign off, here's a glimpse of what's on the horizon. Next, we'll be diving into advanced trading strategies that will take your market knowledge to the next level. There's a lot more to explore, so stay tuned for deeper insights and strategies that can give you an edge in your trading journey. We're eager to hear what you think about today's discussion. If you have any thoughts or questions, feel free to drop a comment below. Let's keep the conversation going and make sure to stay tuned for more exciting topics that will help you take your trading knowledge to the next level. Thanks for watching, and remember, keep learning, keep investing, and we'll see you next